time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Let's get into Champion Iron, symbol CIA on the TSX. It currently trades at a price of about $6 and a market cap of $2.95 billion, being down roughly 13% year to date. The company also pays a dividend with a yield of 3.4%. Champion Iron is an iron ore producer which owns and operates Bloom Lake Mining Complex located on the south end of the Labrador Trough, approximately 13 kilometers north of Vermont, Quebec. Bloom Lake is an open pit iron ore operation with a mine life of roughly 20 years and a concentrator that primarily sources energies from renewable hydroelectric power. So they released a Q4 preliminary release, and that is for the March 31st, 2023 period. So they're offset by about 9 months. The company had produced 3.1 million metric tons of wet metric tons of iron ore concentrate at 66.1% grade. That is a 41% year-over-year increase. This is on the back of Champion ramping up its Phase 2 expansion project, which the infrastructure was also completed during this quarter. And once fully utilized, the company expects a capacity of 15 million tons of ore per year at the 66% grade. The company also reported it had a $79 cash cost per dry metric ton compared to $60 in the prior year. Cash cost was higher in the quarter due to higher fixed costs from its expansion of Bloom Lake production, as well as inflationary pressures compared to the prior year. So those are from oil costs, labor costs, those types of costs. Further, the company is looking to increase the grade of its ore concentrate to 69% through its direct reduction pellet feed or DRPF project. As of right now, the company has budgeted an additional $52 million after positive findings of its feasibility study. The higher grade concentrate allows uses in electronic arc furnaces over gas furnaces, which have a lower carbon output. The increased grade in iron ore concentrate attracts a premium over the current 66%. The project is expected to cost a total of $470.7 million and take roughly 30 months for construction, which will put it in the second half of 2025, assuming it all goes to plan. The company also reported it has a cash and equivalent position of $327 million, which with the debt staying at roughly the same quarter as the prior quarter, we don't know, I'm just assuming it will be roughly the same. The net debt and leases would be about $192 million. Once the full results are leases, it might be slightly lower as they're paying off debt, they're paying down their leases, but it would still be a net debt position overall. However, as we love, with commodities, they're fluctuating a ton. And like Brennan was saying for his last segment, they're volatile, and this has not been any different from oil to it is now iron. For fiscal Q4, we saw higher index iron prices ranging from about 110 to 130 throughout the quarter compared to 90 to 110 in the past quarter. But since the quarter end, so this would be in April, we've seen it now drop to the low 100s, which is about a 6-month low. So for valuation, using the fiscal Q3, so we're about 6 months out of date here. At this point, the EV to EBITDA is about 6.7 times. However, this is hard comparables because the fourth quarter of last year, so fiscal Q4 2022, it had very high iron prices, or about 200 to 220 a ton at that time. But the cash position has also improved during this time, so likely you're going to still see an EV EBITDA after the full Q4 release around still 7 times. So if the stock stays similar, that is. The valuation is higher than what it was about a year ago, but that's because this coming off these high comparables. But it's not absurd at this time. It's quite reasonable given the near-term growth that we're seeing in production. So in conclusion, it's had its margins contract severely over the past year. That's the risk of commodities. We see the iron ore price come down. We see the costs go up. So there's your margin contraction. But it's also had tremendous production growth. And it will likely see another 20% once the full capacity comes online from the Phase 2 project. With additional value added from the DRPF project by late 2025, it's reasonably strong balance sheet. It's not a bad choice if you want iron market exposure, but like we say, it's a commodity. It's going to have that risk. You're going to see heavy fluctuations over the next 2 years, regardless of how the company performs, and you can't exactly count on these long-term projections that you'll see some analysts make. We don't like to do those. So I'll open it to you guys.
Yeah. I was just taking a look at the analyst expectations here, and for the current year, it looks like analysts are expecting 44 cents in earnings per share, down from $1.06 last year. So big drop expected this year, and that puts the valuation about 14 times roughly. Yeah, I mean, it's a little high for a commodity stock, but I mean, earnings are expected to then grow pretty significantly in 2024.
Yeah, I guess we can look at those estimates, right? But I mean, we saw like on this stock, or on just on the commodity, it was in a low of $80 in November, and it went to, by March, 130. So I'm not sure how you can forecast any cash flow based on that. It's so difficult. I know what you're saying, like that's the estimates that are out there. But I mean, for us, we're analysts, to look at that. How could we forecast? You can't even forecast 3 months out, let alone 2 years out on the business. It's just makes it very difficult. If I was going to buy one of these businesses, I would look at the management team, look at their experience. I would look for a great balance sheet, net cash, because they will have to weather an inevitable downturn at some point. And then I'd look to, are they growing their production? Now, you could check off some of these boxes with Champion. Net cash position isn't there, but I mean, they do create cash flow in good times. Now, I would add to the criteria there is I would want to buy it in a down cycle. And the thing is, it might look actually like it has weak earnings then, but you'd actually want to buy it in a down cycle. And then when the commodity prices came up, and it may look more attractive, then it might be a sell. So it's a completely different scenario, and it's trading versus investing. So it's not something we really do. But if I was to look at a business like this, I'd want a great management team with experience. I'd want that good balance sheet. I'd want production growth looking forward, and that fully funded from cash on hand. And then I'd want it at I'd want to see the market for the underlying commodity be a complete crap show. Basically, it looked as bad as it gets, and then that would be a time to buy, which is a really strange, because you don't know how bad it's going to get. And then it's with only risk capital, because it could get worse, but you'd want to have that balance sheet. So it'd be looking at it totally different than the way we look at, I want to see a long-term growth track record ahead of us, reasonable price, pay a reasonable multiple, but a good business. So, and sustain that cash flow growth long-term, which is what we look at for a long-term investment. So a totally different scenario here. I mean, it's interesting to look at, but very hard to predict. Like Aaron was looking at the estimates there, but we just looked at what steel did, I think or iron ore, sorry, not steel, whatever commodity it is, to be honest.
It's related.
Whatever it did over a 6-month period, it's just so hard. We have estimates there from analysts. I don't know how I would do the estimates on that company over a 6 or even a 2-year period, which is what we're looking at there, because it's just, you're dealing with a commodity that's going literally like this.
Just to give an idea, Brennan sent me his report, which was done about last year around this time. It was about $6 price. I think it was about actually a 602, and the valuation for EV/EBITDA at the time was about half at 3.5 times, somewhere around there. So same price, and it now is double the valuation metric, and we decent chance that we'll have a ways to go if the iron ore continues down as we've been seeing over the last month or so.
Yeah,
interesting.
Exactly. And I remember even saying in that report that, because we've seen, iron ore come down, it's got some tough comparables to go against, which obviously is why we're seeing the valuation go up, just with that commodity price coming down. But yeah, it was an interesting business. Like Ryan said, they've, increasing capacity, which is always something, we're on way for growth, but it just comes down to, that volatile nature of the commodity. Management can do, we've said this so many times on the podcast and so many times to clients, but management can do everything right. And if, the commodity price turns against them, well, the stock will likely perform poorly.
Yeah. So in your portfolio, if you like this company, like this sector or whatever, a commodity, it's a trade versus a investment over the long term, because it's just going to do this.
They also initiated a dividend, I believe, in 2022.
Around the same time, yes.
While commodity prices were sky high. So, or I guess kind of back a little bit before. Yeah.